you're in partnership with these tenants, right? You want to be a good landlord. You want them to be a good tenant. So I always tell people to just get information. They're asking you for something, ask for something in return. Hey, I understand you want a rent reduction. Why is that? Oh, well, our sales have continued to decline. Okay, well, I have no problem working with you, but can you show me your sales? Can you give me the sales for the last 3 years? Most of the time, the tenant's not going to do it. If they don't do it, how can you expect me to just, reduce your rent when I don't have any evidence? Hey, I want you to succeed, but, I've just got to make sure I'm making a good decision. Oftentimes, these landlords have debt on the property, so you can't just necessarily renegotiate the lease terms. You're going to have to go to get lender approval and things like that. So I'll oftentimes tell people, kind of throw that back to the tenant as well.
Hello, everyone. My name is Chris Powers, and I want to thank you for joining me on the Fort Podcast today. This show is an open-ended discussion and journey covering real estate, business, entrepreneurship, and investing. I would love to hear from you by tweeting me at Fort Worth Chris on Twitter. And if you've enjoyed this show, I would be super grateful if you would subscribe on Apple or Spotify or whatever platform you're listening on. And if on Apple, if you would leave a rating and review, it would mean a lot. And last but not least, you can check out all these episodes on YouTube. Hey guys, it's Chris. Thank you so much for joining me today on the Fort. I have my cousin, but also a great friend, Vincent Knipp, with me today. And Vince is the Senior Managing Director of Investments at Millichap. He's the number one single-tenant triple net broker in the state of Texas, almost clearing $1 billion in transactions since he started. Today's episode is awesome. We talk about the market for single-tenant triple net assets. We talk about 1031s. We talk about what makes a good investment in this asset class. We talk about what makes a great broker and a lot more. So thank you for continuing to join me, and I hope you enjoy the episode. Vince, thank you for joining me today.
Appreciate you having me. Thanks for the kind words.
Yep, it means a lot. Let's just start with kind of your story, kind of into the industry and kind of what you've done over the last 15 years.
Sure. So grew up in El Paso, as you said. My dad was involved in both brokerage and real estate.
Yep.
As you know. So I used to drive around with him when I was little in his pickup truck, and we'd go to Dunkin' Donuts in the morning, and he'd go to the P.O. box, and he'd open up his mail, and he'd have various checks from his real estate investments. So I used to always say to myself, I want to grow up and do real estate, because I thought I could just drive around all day and cash checks. I didn't actually realize what went into it, but that was kind of my first exposure to it. And then his day job was brokering pecans. And so they came from a large, nut company and past experience, and he was helping people buy and sell pecans. And I used to go with him to these meetings and go to these lunches where he'd have all these farmers with him. And, I would just ask him, why are all these guys having lunch with you? And he said, well, because they need me. I know the market. I know the prices. They want to sell product. And so that was probably my first exposure to the brokerage side of things. And, I've always been one where I kind of like to do things my way. I like the idea of kind of driving around, having lunch with people, and, I guess maybe controlling a market or a product. And so that was kind of what got me interested in brokerage. So grew up playing various different sports, played tennis throughout high school.
One state.
Doubles. I'll throw it out, doubles. It wasn't singles, but my partner and I won state 5A doubles our senior year. And then our team was really good. These were all juniors that grew up with me, and we won state as a team. We got second, we got third. So it was a lot of fun. Then graduated, went to the University of Texas at Austin, worked for a good friend of mine that was in the real estate business. They couldn't afford to pay me, but I just wanted to get my feet wet. So I worked for free. I did a whole bunch of work for them. And then after working for free, they said, okay, you're good, you're hardworking. And they started paying me. And they were doing mobile home park acquisitions, things like that. And it didn't really interest me. I've always kind of had an eye for retail, like driving by it. That's what my dad was invested in, various shopping centers. And then one day, these brokers from Marcus and Millichap walked in, 3-piece suit, binder, looked really cool. And, they had the attention of my two bosses. And I'm thinking, these guys are young like me, and why are my bosses so interested in what they have to offer? So I sat in on the meeting, and that's kind of when I decided, hey, I'm going to go be a broker.
Yep.
So that was the beginning of it.
So you make that decision, and then you move up to Fort Worth from Austin. Take me through a little bit about like the first years of being a broker, because a lot of people flame out in their first year or two. So like, what did you do? And then let's just talk about maybe as it's specific to Marcus Millichap and their process and why you kind of broke through and have been doing it for so long.
So it's incredibly challenging. Obviously, it's a straight commission-based gig right out of school, and you really don't know anything. They've got a great training program, but at the end of the day, it's really on the agent to ask the questions and go out and really, become a student of the game. You can't just be successful by going to their training and doing a few of the little things. So, my hours starting out were probably 12 hours a day, 7 days a week. I mean, I was a nerd about it.
Yeah.
I would read, I would look at leases, I would look at on-market properties, sold properties. I was talking to anybody and everybody. I was meeting with anybody and everybody I could, even if I didn't have a reason. I would just honestly say, look, I'm new in the business. You've built a great portfolio. I'm going to be around. Probably not going to bring much value to you now, but let me buy you a cup of coffee. And so that was my focus. Really, the first year was just meeting everybody.
Yep.
And you don't make any money. So the first 18 months, I think I made $6,800. So, it isn't easy. A lot of people that come in now and kind of from an outsider's perspective, they look at it and they think that it's easy. They don't realize the blood, sweat, and tears you put in early on. So to your earlier point, a lot of people don't make it.
Yep.
Everybody says they're hardworking. Everybody says that they're competitive and they're gonna, do whatever they need to do. But inevitably, people come in and think their way's better and don't really take to the coaching. So,
and everybody I talk to, they are always building a database. What is it? Is it just an Excel sheet, or is this what's the mythical database that all Marcus agents build?
So it's changed a lot since I first got in the business, because it was Excel. I would sit here and I'd export records from the county appraisal district, building square footage, lot size, parcel ID, ownership information, deed date. And because I was based out of Fort Worth, my goal was know every single property in Fort Worth, retail oriented. So you'd export it and then you just sit there for hours at a time. So really the first 6 months, that's all I did is I just, lived in Excel, researching owners, building my database, adding phone numbers, calling, verifying. And so that it's an ongoing process. We still do it. We track the market. We look at every deal that comes to market. If we don't have it in the database, I get a little upset with myself because I feel like we should have everything. But as you can imagine, new development, you're not always going to have it all. So
for sure,
it's an ongoing process. Unfortunately, I don't sit there hours at a time databasing anymore. We've got some really great analysts with us that do that.
And you have so many clients now. What you can always tell when a broker's like just gotten in the industry and is calling you for the first time. And I honestly try and be really nice and thoughtful and not just like totally shatter their dreams on the first call. What did Marcus teach you about like making the call? And like, if somebody's listening here that might just be getting started, like how should they think about making those first calls?
You go through the training and they teach you the interest generator, bringing value, asking open-ended questions, and it's all true. I mean, it's not.
What's like an open-ended question?
Why'd you buy this property?
Yeah. Okay.
Versus, hey, I'm calling about this. Do you still own it?
Yeah.
So you just always want to get the client talking. And I think one mistake that new agents make, and I was guilty of it too, is you're nervous. And so you're trying to create all this value and you're telling them everything that they should know. And at the end of it, you realize you haven't even given them a chance to speak. And so I was guilty of that in the beginning. And then I don't remember what it was, but one day I just realized that, I need to stop talking.
Yeah.
And the reality is, they know you're new. You're never going to be able to plan out every call. You're never going to be able to, make them think that you're not right out of college. So, I mean, they can hear it from the second you call. And, my script over the years has changed. I started out Vincent Knipp, Marcus Millichap, focusing on this, on and on.
I've never sold the building, but you should let me sell yours.
Well, and honestly, that was another thing. That's a thing I tell some of our newer guys is, hey, look, they know you're new. So don't try to trick them.
Yeah.
Don't try to convince them or convince yourself that you know what you're talking about. It's okay to say, hey, look, I'm new in the business, but I'd love to sit down with you. It's all about getting in front of people.
Yep.
You can't do business over the phone. And even with Net Lease, a lot of these property owners are out of state. So it's very difficult to just call somebody and convince them why they should hire you. Now everybody's different. Some people do that, but
Right. All right, let's move into just a little. Let's start just like getting into kind of the business side of things. So, like I said in the intro, you really do, and you said like your love is like driving around and seeing things. You have an eye for retail. So, what does an eye for retail mean? Like, what makes great retail, and is it tenant dependent? Or I know it's a big question, but let's just start there.
It's all of the above, right? Tenant, location, submarket, your rental rate, et cetera. But I think the most important thing, especially when it comes to retail and single tenant specifically. So I used to do shopping centers, and about 6 years ago, I started referring shopping centers out. I've got a business partner, and we'll refer each other business back and forth. He'll refer me single tenant, I'll refer him multi-tenant. But
Okay.
On the single tenant side of things, the number one thing is location. Yes, the lease matters. Yes, the tenant matters. All of that matters. But at the end of the day, I tell people when you're theoretically putting all your eggs in one basket with one tenant, you've got to look at the real estate and the location.
Right.
So does it have good access? Is it located at a signalized intersection? Is it big enough that if your tenant went out, you could redevelop it and put a different building, or you landlocked, et cetera? So I really think the biggest thing is just location. You want to buy something, and to me, the tenant and the lease and the income is a perk. But at the end of the day, if something ever happens, you want to know that you're going to have a line out the door of new tenants that want that building.
Right. And if it's an amazing location, are there certain aspects of a location that could make it just not viable? Is it like the size of the site or the size of the drive lanes, or kind of what happens when you have a great location, but it only fits like one user?
Yeah. So that's another thing that a lot of people worry about. Some people won't do these little oil change facilities because they're on, a half acre and they're a little tiny building, and that's always what it's going to be. You're never really going to be able to redevelop it. So there's some buyers that won't buy those for that specific reason. I'm a big fan of, you want to be better off if your tenant leaves. Now, it's hard to always say that, but if you buy a building that's 4,000 square feet, but it happens to sit on an acre and a half, someday if that 4,000 square foot tenant goes away, you might be able to get two pads out of it, two buildings on it, or add on or something like that. So that's something I always look for.
Why do you put all the multi-tenant buildings with your partner? Is it just so you can stay laser focused?
So when I first started, I'd work on anything retail related because, you just want to get paid and you want to have a track record and say, hey, I've done this deal. So, my very first listing assignment was a piece of land. Actually, I think my first 3 listing assignments were land. And I called every developer and every single person I could and never sold them. And then I realized, I'm not a land broker. And so I shifted focus and then obviously quit doing land. And that's another thing for new agents. I think it's easy to get distracted. Somebody says, hey, I know you called about this, but I have this other project, which I've learned to mean was a problem and, really a project more than a paycheck. So
right.
I would, I've kind of shifted my focus and started just really focusing on the buildings.
Yep.
So, God, I forgot the question.
Well, the question is, why do you move all the multi-tenant to another group? And is there a reason because of the nuances between single tenant and multi-tenant?
So I'm ADD. I'm fast paced. I like a lot of deal action, deal flow. Shopping centers take a little bit more time.
Yep.
So with single tenant, there's one lease, one tenant, one rental stream, one estoppel, and that's really it. With shopping centers, you can have 5 estoppels, 5 tenants, all different lease structures, and it's just more cumbersome. With shopping centers, you're typically responsible for roof, structure, parking lot. There's more maintenance involved. With single tenant, it's a little bit more passive, depending on the lease structure, but a lot of the times the tenants will maintain these things. So for me, it was really more about volume.
Yep.
In the first cycle, when I started in 2007 and everything crashed in 2008, I saw a lot of guys that made no money. I mean, there was no deal flow. Everything shut down. And so I kind of told myself, I'm never going to make that mistake. I want to try to close as many deals as I can so that when the next recession comes, even if my volume's cut in half by 50%, I can still eat and pay the rent.
Yep.
So that was kind of the shift I made was I'm just going to do single tenant. I'm going to bump up my volume. I can, get through these quicker.
Yep.
And so that's why I made the decision to refer it. And in all honesty, I just it didn't excite me all that much.
Yeah.
And I'd rather, put my heart into something that I really like. And the partner that I have in this he's number one in the state and one of the top, I think, 2 or 3 guys in the country. So it's easy to refer it out because I know he's going to get it done, and vice versa. He wasn't 100% passionate about single tenant, so it was just kind of a natural, made sense for us.
All right, let's talk about buyers and sellers. Who are the typical owners of this stuff? Is it groups that hook up with Starbucks and build them 50 a year, and those are your clients? Is it families that just own 1 or 2 of these as investments? We're going to talk about the typical seller and then the typical buyer of this stuff.
So the answer to your question is all of those people.
Mm-hmm.
So we do a lot of work with developers that build for specific tenants, Starbucks, Dollar General, et cetera. And that's kind of their pipeline. And they may build for 2 or 3 tenants, but we do a lot of work with them. And so their goal is to, get the product out, sell it quickly. And the buyer of those is typically a private family. Funds and groups are out there, they're buyers, but they typically want a discount, which is okay. And there's developers that sell to funds, but really what we're known for is maximizing value, driving price.
Right.
And we do that with just your private client buyer. So a lot of California family offices, New York, Florida, all over the country. And so those are the people that are typically passive. They're selling out of another asset. They want to put their money to work. They're looking for something safe, stable. They don't want to deal with roof leaks, parking lots, anything else. So they'll typically accept a lower return for that, freedom.
Yep.
So that's who we do a lot of our work with. And then again, most of these people are buying something with a 15 or 20-year lease. As that lease term starts to burn down, they'll typically sell and transition into something with a newer, longer term lease. And so again, we'll do a lot of private family sales as well.
So is that what drives the majority of sales, is families thinking, all right, we got 5 years, 7 years left on this lease. Let's turn it now. We've captured a few rent bumps. Let's turn it now and get into the next thing.
Yes. Because in single tenant net lease, as that lease term gets shorter, in theory, the value of the property goes down because the buyer pool is smaller. There's more people out there that want a 15 or 20-year lease versus a 3, 4, 5-year lease.
Yep.
Now, there's buyers out there that feed off of those 3, 4, 5-year leases because typically there's a discount, for taking that risk when you're going to have some rollover in the next 3 or 4 years. I tell people that options are really only to the benefit of the tenant. They don't do you any good as a landlord. So
why?
Even though you may have an option in 4 years that says my rent's going to go up 10%, if the tenant calls you and says, our sales are going down, we can't renew. In fact, we need a rent reduction. Oftentimes, what are you going to say? When you live in California, Florida, you haven't seen the property.
Yeah.
You don't want a vacant building.
You're so, okay, we'll take it.
Yeah. So, oftentimes you take it. And again, it's a chess match. These tenants, honestly, probably ask all the time. They're notorious for it. They're trained for it. They hire third-party people that go out and negotiate rent reductions on their behalf, and that's how they get paid. So it's just a big cycle. But back to my earlier point, location. If you're sitting on a great location and you know that you could backfill it with 15 other tenants and potentially even get more rent, it helps to be able to say, it's all right. You can either take your option or leave. And there's people that'll play that game. So
what's if you're a private family in California, should you, and you got a tenant that's kind of, playing the game with you, what do? Just call a leasing agent and say, hey, shop this around for 30 days and tell me who in the market would take this before I get back to Starbucks or whatever.
Yeah. Most of the time that's what they do, or they do nothing and they just accept the reduction.
Yeah.
But what I often tell people is we're more than just investment sales, or at least I look at myself more as a partner and advisor. Sure, I can sell anything, but I've also got a ton of information. I look at this all day, every day. I know where rent should be. I know where, tenants, their rent may be above market, below market. And so oftentimes we'll come in and just advise them and say, look, here's all the rent comps. Here's everything in the market. You don't need to reduce it.
Right.
And so we'll kind of arm them with this information. We don't charge for it. I'm just trying to build a relationship. And in the event we can solve their problem and they decide to sell it, it makes winning that business a lot easier because you've actually just created a whole bunch of value for them.
Yep. Who are the buyers that are buying with 2 to 3 years left on a lease? Is that value add folks, more opportunistic folks?
Yeah, people that are trying to chase yield. Some of these people have relationships with these tenants where, they know that the tenant isn't going to relocate or move or close down. So they'll buy these to get that little bit higher return. And then they'll hold the tenant's feet to the fire in 2 or 3 years and make them take their option. And then they'll typically sell out at that point, or they'll just hold it. So again, the longer the lease, typically the lower the cap rate, lower return. Shorter the lease, more risk is perceived, the better return you can get. So there's some people out there, they call it blend and extend.
Mm-hmm.
There's people out there that play that game, and that's what they do all day, every day. And that's okay. There's a business model for that. Those deals are getting harder to find. And with the market and the environment that we're in today, cap rates have compressed so much as a result of COVID and everything else that there's really not even that much spread anymore.
Right.
There used to be a spread. It used to make sense.
Yeah.
But now people have realized, hey, if I can get 50 basis points better or 75 basis points better, I'll just buy this and take the risk because there's so much liquidity out there.
Yep.
And so, again, for the people on the call that maybe don't understand that is, there's really not enough spread to renew the lease, then sell it, pay your closing costs, commissions, and actually, have a return. So before there used to be a much wider gap, whereas, you might have 150, 200 basis points of spread.
Right. What do you like when I think of single tenant buildings and I think of a major metro, it makes a ton of sense to me. And then you go to these, especially more prevalent probably in Texas, but you go to these smaller towns and cities where there's like a Dollar General and a Jack in the Box and a Long John Silver's. How do you value those differently? How do you value a Dollar General differently in, say, great spot in Dallas versus Andrews, Texas? I think you have one in Andrews, Texas.
Yeah.
We don't have to talk about that one if you want to talk about another one.
No, we can talk about it. There's always been a difference in price and yield and demand in a primary market versus secondary versus tertiary.
Yep.
The tertiary stuff isn't in demand as much right now. Now, there's still buyers for it. Don't get me wrong. But if you're in a primary market, you might see 100 basis point difference just because it's in Dallas, it's in Austin, it's in San Antonio, it's in a major market.
Right.
And so there's always been a slight difference. I think that the premium you can command in a primary market today, I've never seen anything like it. We just closed a Dollar General here in DFW last week at a 4.99 cap.
Wow.
Which is crazy, crazy.
Good location.
Yeah, great location.
Yeah.
But at the same time, it's still a Dollar General with a flat 15-year lease.
Right.
So, that
there's
product,
there's not even inflation bumps.
Not until you get to the options.
Okay.
And like I said, an option is just an option. Doesn't mean the tenant's going to pay that 10% bump.
Yeah.
Secondary markets, you're probably 5.5 cap to 6 on something like that in today's market. So about a 50 basis point difference. But buyers have gotten smart. They've realized that when a recession comes, or if my tenant leaves and I bought something in the middle of nowhere, I could potentially be screwed.
Yeah.
So now they've gotten a little bit smarter and want to be in those primary markets, and they're willing to pay more. And I think it's a smart bet. Now there is still a market for, the secondary, tertiary markets because you can get a better yield. And as long as you're buying at the right corner, it's the right economics, I still think it can make sense.
And who's buying that stuff? Same people. Just if the deal's better, I'll go to a tertiary. If it's
so with some of these other markets, obviously the rents are a lot lower.
Yeah.
And so therefore the price is lower. It's a little bit more affordable. So sometimes people will have these large exchanges and they'll buy 3 or 4 properties and they may have $1 million, $1.5 million left over. And so they'll just kind of throw it in. They'll kind of look at it as a portfolio. They'll throw it in, take the risk because they don't want to pay the capital gains.
Right. In a market where rents are growing quickly, like let's just say you signed a 20-year lease in like 2010. The odds are the current rate that tenant's paying is so far below market, even with 3% bumps, even if you had 3% bumps. But let's just say you have another 10 years left on the lease. Are there a lot of buyers that'll buy something on like a 2 cap because they're just, even with 7 to 10 years left, if that delta is so large, then they'll just wait it out?
Absolutely. there's all different types of buyers. Most people aren't that patient. They're not going to wait 7 to 10 years. Sometimes buyers will even wait longer. But typically, it's your high net worth family office that's more concerned with wealth preservation than just, hey, I need a return in the next 5 to 6, 7 years.
Yeah.
It's one of those situations that I said where you want your tenant to leave because you're going to be better off because you're going to be able to go get 2 or 3 times the rent. So, there's a lot of properties out there, and from my standpoint, that's what I like selling, and that's what I'm really good at, driving the value, because I can look at something like that versus a lease that was signed today, and the rent's 30% cheaper. Therefore, my asking price is going to be 30% cheaper than a new product.
Right.
So I can drive my cap rate down. I can command more of a premium because, again, I'm a broker, so I can sell against anything. But it's hey, look, you're buying this for $1.5 million versus new construction today is going to cost you $2.5 million. It's the same product, same tenant, same market. I mean, I would accept, 0.5% return, 50 basis points less all day if I could own something like this, because you're never going to get hurt. And so that's one way we can really drive value for some of our clients that have these older deals to where they're not really, taking a discount. And you mentioned 2 caps. So one of my favorite deals, we sold
let's hear it,
an
baby.
Albertsons ground lease in Dallas several years back. And I kind of looked at this, and we were in competition with 2 or 3 other brokerage shops. And it's that exact model that I just talked about. This lease was signed back in the 50s. So they were paying something like $2 a foot in rent. Now, they had a whole bunch of term and everything left to go, and most of these brokers proposed on it based on a cap rate. I came in and I said, this isn't a cap rate deal. There's going to be somebody out there that sees the value of controlling 6.5 acres in Dallas, even if they have to wait 15 years. And we ended up selling it, I think, at a 2 cap. So we had 38 offers. It was, we knocked it out of the park. We generated $1 million more in proceeds than the next broker that we were in competition with. So you've got to be able to shift and kind of look at deals in a different way.
What's the difference between talk to me about what a ground lease is versus just buying fee simple, the whole thing.
So in a ground lease, you're just buying the ground.
Okay.
That's it. You're not
you
buying,
own the dirt.
You own the dirt. You don't own the improvements. The tenant owns the improvements. With a ground lease, you don't get any depreciation because you can't depreciate land.
Okay.
Fee simple, you're buying land and buildings, so there's there's a benefit of depreciation there.
Right.
That's something else we can talk about is, what's better, buying a ground lease or fee simple?
Let's talk about it.
And my response is it depends on the lease and the rent and the location.
Let's talk about it.
Most buyers think that a ground lease is the ultimate hands-off investment. Hey, if it's a ground lease, I don't have to do anything. And that's true because the tenant comes and builds the improvements and they lease the dirt from you. But an absolute net lease on a fee simple property is the exact same thing. You never do anything. But the difference is you actually get the benefit of depreciation.
Right.
So I would almost argue against it's better to, buy these fee simple absolute net deals than a ground lease in today's market.
Okay.
Historically, the benefit to buying a ground lease was the tenant would come build the building at their own improvements. Therefore, the ground rent would be a much lower payment.
Right.
And so typically you would end up being able to buy a ground lease for a lot less than you would a fee simple asset.
Right.
In that instance, it made a lot of sense because if your tenant left, the building reverts back to the landowner, and in theory, it should be worth more. So we would sell some ground leases for $1 million.
Yeah.
But there were $1.5 million worth of improvements.
Right.
So if the tenant defaults, you've taken your $1 million investment to theoretically $2.5 million because you now own the building.
Yep.
But in today's market, these ground rents have gotten so high, cap rates have gotten so low, you're paying $3 or $4 million for a ground lease.
Yep.
It's no longer below replacement cost. So you've got to be careful with ground leases.
And so, and like you just said, if a tenant leaves, they just leave the building and here's the building.
Yeah. You don't really want your tenant to leave and, have a $4 million fast food restaurant.
What usually happens when that happens? Do the landowners just demolish it and take it back, or they?
I've seen it a number of different ways. Sometimes, they'll scrape the building and ground lease to someone else, maybe a bank or, something like that. Or other times they'll just get another tenant that'll come in and backfill it. We sold a Taco Cabana, great hard corner freeway location a few years back. They started closing stores, ran into some issues, and now Raising Cane's is taking it over. So Sometimes you can end up better off. Sometimes
Yeah.
it's worse off. Again, it comes down to location. If the market moves, if you were in front of a Walmart and all of a sudden Walmart relocated to the other side of town and now you're sitting in front of a vacant box and the market shifts, you're probably not going to better your position.
If just on that instance, if Walmart's leaving, do they usually surprise all the retailers up front, or they're usually kind of in cahoots and they kind of know it's coming in advance?
No, I don't think they tip them off.
Yeah.
And there's rumors out there that Walmart has never closed a supercenter, and I think that's true, but I know they've relocated them.
Yeah.
So I think it's kind of a marketing thing.
It's a marketing thing. Let's talk about leases just in general. I guess the first question, are all of these leases, you think of the Starbucks and the Dollar Generals and the Raising Cane's and my favorite Burger King, are they all pretty much the same lease, or does everybody come at it differently?
What's your favorite? Why is Burger King your favorite?
Because we're from El Paso, and that was like close to Coronado High School, and that's where we grew up going. And Taco Cabana was on the other corner. So
yeah. I love Taco Cabana.
I love Taco Cabana.
To a certain extent, most of the leases are the same. Each tenant has their own lease form, but over the years, they've kind of gravitated to this absolute net lease model where they know that the owners don't want any involvement.
Right.
So there might be some provisions that are different amongst the leases, but for the most part, they're pretty boilerplate. It's evident that the tenant's responsible for all maintenance, the roof, etc. Where they differ is some tenants will report sales, some don't. Some might have a percentage rent clause where others don't.
Describe a percentage rent clause.
So, and I don't see it as much as I used to, but back in the old days, tenants would have a fixed rental amount,
right,
and there'd be a percentage rent override on gross sales above a certain amount. And for a long time, that was really great for the landlord, because as the tenant's business would grow and inflation kicked in, their rent would, in theory, continue to go up for forever. In today's market, tenants have gotten smarter. They don't want to report sales because they don't want their competitors to know what they're doing. And I think really they just want to know what they're paying for the next 5 years and not have this moving target every year as they continue to grow their footprint and they've got thousands of locations. So most tenants have kind of negotiated that out of their leases, and there's some old leases out there that have it. When they come back at renewal, they'll say, look, we'll raise our rent, but let's get rid of that percentage rent clause.
Yeah. Because
that's valuable information. And that's stuff I thrive off of, because again, in the example of somebody who has 2 or 3 years left and the tenant says, I may leave, if somebody calls me and says, hey, well, the tenant's doing $2.5 million in sales and they're paying $75,000 in rent, I can easily say they're never going to leave. And so when you have that information, you can kind of use it against a tenant.
Yeah.
It helps your position. So again, they don't like that either.
Let's say a tenant's not on percentage rent, but they say they're going to leave. I guess the owner can always ask, but just say, hey, show me your sales.
Oh, yeah. And that's another thing we tell everybody is I tell people to, you're in partnership with these tenants, right? You want to be a good landlord. You want them to be a good tenant. So I always tell people to just get information. They're asking you for something, ask for something in return. Hey, I understand you want a rent reduction. Why is that? Oh, well, our sales have continued to decline. Okay, well, I have no problem working with you, but can you show me your sales? Can you give me the sales for the last 3 years? Most of the time, the tenant's not going to do it. If they don't do it,
that's probably
how can you expect me to just reduce your rent when I don't have any evidence? Hey, I want you to succeed, but I've just got to make sure I'm making a good decision. Oftentimes, these landlords have debt on the property, so you can't just necessarily renegotiate the lease terms. You're going to have to go to get lender approval and things like that. So I'll oftentimes tell people, kind of throw that back at the tenant as well.
Okay. Real quick, back on the 2.5, I know it was kind of generic numbers, but you said 2.5 million in sales. They're paying 75,000 rent. I know for sure they're not leaving. Is there a certain ratio that matters, or at what number would you have said, okay, they might be leaving? So
that's a good question. When it comes to these fast food and restaurant operators, you want to see a rent to sales in the 6 to 8% range. That's what we would say is healthy.
Okay.
When you start getting into 10, 11, 12% rent to sales ratio, they're not making as much money. It's tight. So that's kind of the magic number. Obviously, if it's 3 or 4% of sales, that's great for the landlord. They're never going to leave.
Yep.
So 6 to 8% is really where I would tell you is kind of where I would like to see it.
Yeah.
Now, in today's market, rents are getting pushed. We do sale leasebacks where you might structure it at a 10% rent to sales ratio.
Yep.
So again, buyers are willing to accept a little bit more risk. And that's a game for tenants also is, when we're capping these at a $70,000 rent versus an $85,000 rent, that's a huge difference in purchase price or proceeds for the tenant.
Yep.
And so sometimes, they may pay a little bit more in rent today to get more in proceeds because that pop happens immediately.
So what you had just said, the 2.5 million to 75, that's like roughly 3%. Okay, if you're a landlord and you know that there's 3 or 4 years coming, or 3 or 4 years, you kind of know what your next rental rate's going to be. It's basically like we can basically double rents and still keep them at 6 to 8%.
Correct.
That's kind of the easy formula.
And I think another area where you can, I don't mean take advantage, but just capitalize on something like this is the tenant runs out of options. That's when the power shifts to the landlord, because at that point, the tenant no longer has an option to renew. So if you've got a rent to sales ratio of 3% and they may only have one option left and they come back to you, you may say, hey, let's recast this entire lease. I'll make you a fair deal now because I know your sales are great and I'll lock you in for another 20, 25 years.
And was it almost unheard of that a tenant wouldn't have an option in their initial lease?
Yeah, I'd say 95% do. You may find a random one-off kind of sale leaseback or owner user that will sign a 10-year lease and sell the building.
Yeah.
But typically that's because they're out in the 10 years anyways.
Yeah.
But it's rare that you find something without options on a new deal. Now, you can buy stuff on the open market today that they're in their second or third option and they might only have one left.
Right. And if somebody's been there 15 years and blown through 3 options, it's very likely they're going to keep going. I mean, at like what point is it purely a function of sales when somebody's going to decide to leave, or maybe the area is just deteriorating, or why do people leave?
Yeah, I would say mainly just because the market shifts.
Yeah.
If a tenant has good sales, if they're still at, what I call ground zero and there's traffic and it's vibrant, I don't see them ever leaving. Now, sometimes tenants outgrow their existing prototype and then they may move.
Okay.
And as their sales continue to grow, they may go to a double drive-through model.
Yep.
So Dollar General is one where their prototype used to be 7,500 feet, 8,000 feet, 8,500 feet. They're now up to 9,000 and they've got a 10,600 square foot store. And as their sales have continued to grow, they've added grocery, they've added fresh produce. And so they may have the store that's doing gangbusters and the rent to sales may only be 3%, but it's easy to pick up that building and move next door. Now they have the latest prototype. It's new. Yes, they're paying a little bit more in rent, but in theory, their sales are going to grow too. So you've got to be careful of that. But again, if you're at ground zero, there should be a line of people out the door waiting to take over that building.
Right. All right. I want to get into kind of COVID lease changes, but before we get in that, if we're just looking at kind of a lease, besides kind of price and term and a few other kind of the standard, is there anything you like to see in leases that if you were buying a deal or if you were selling, maybe it's different depending on who you are, but something that stands out to you that's like, this is what makes a good lease if you're a novice and you haven't seen one before?
I like the sales provision clause.
Yeah.
And again, it's harder to find, but that's something that I think you can kind of ride that wave with your tenant.
Yeah.
If you see their sales coming down 3 or 4 years in a row, kind of makes you question your investment. You can do some diligence, figure out what's going on, or maybe you decide, hey, you know what, their sales have gone down 3 years in a row. I'm going to go ahead and sell it.
Yeah.
As long as there's still some term out on it, there's likely another buyer for it.
Right.
So I like to see that. And then, rental increases. I think everybody's worried about inflation. With these single tenant triple net leases, they're typically fixed for an infinite amount of time. Walgreens is one example that would sign a 60-year lease without any rent bumps. So, again, I like to see rental escalations. If you can get annual bumps, I like it a little better, but, at minimum bumps every 5 years to keep up with that. And then, again, think about it with these, I'll use Dollar General as an example. The lease is flat for 15 years. You buy that at a 6 cap today with 15 years. Well, it wouldn't be a 6 today, but just for example purposes. You buy it at a 6. You own it for 5 years. You get no rent increases. and now it's got 10 years left, you're no longer selling it at a 6. You're probably selling it at a 6.5, 7. So you're actually going to lose money.
Yeah.
So, I like rent increases and reporting provisions.
If sales are down on a tenant, and let's just, your typical kind of like mile stretch where there's just like 10 fast food restaurants or whatever, is it usually that maybe all 10 of those tenants have sales down, like it's a market thing, or is it an operator thing, or maybe people don't like Burger King here like they do everywhere else? Like, why do sales go down? And is it usually everybody's down together and everybody's up together?
Good question. I would say it's a combination of all of the above. Most of the time, I would think that the tenants would all kind of suffer together. Maybe there's highway construction. Maybe the freeway is under construction and they've closed down the off ramp. So typically, yes, I'll kind of see everybody come down. Now, if it's an operator error, then no, I think it's pretty much just the operator. And we've seen a lot of these restaurants that we sell where they just don't have a good operator.
Yeah.
They don't know how to run the business. They can't control their food costs, labor costs, and they just kind of run it into the ground. And literally overnight, you could see a new operator coming in and start to turn sales around. So I think it's really a combination.
Yep.
But and then again, sometimes like if you think about Popeyes, for example, they were just kind of steady. I think their average unit volume was $1.4 million, $1.5 million. And then they came out with that fried chicken sandwich and just literally, blew the doors off. I think their average unit volume is 2.5 to 3 million now.
Oh, wow.
And it's literally a result of that chicken sandwich. So again, sometimes these companies can pass things down and it helps. So have you had the chicken sandwich from Popeyes?
No, but I'm probably going to get one this week.
I haven't either, but I've heard it's incredible. So
how much do you pay attention to the actual products that these tenants are selling? Because you've now mentioned Dollar General's opening up produce. Popeyes has a chicken sandwich. This clearly matters a lot to you. It drives a lot.
Yeah, it as a broker, I mean, it's information that I need to know because I've got to understand what these tenants are doing to be able to justify why pricing or yields may change out in the open market. Owners, some of these people will do the same amount of research. A lot of them like to get on Yelp and look at the reviews.
Yeah.
Again, there's not really a whole lot you can do. I can't call the operator and say, hey, you've got bad reviews. The dining room's dirty.
Yeah.
They're under a lease. But, that with social media and the amount of information that's available today, that impacts stuff. I've had people say, I can't, I want to withdraw my offer. They have all negative reviews.
Do some of these tenants ever say, hey, look, we're going to sign this lease. We know you're going to flip this building immediately, which means our triple nets are going to like double by next year. Do they just kind of bake it in, or is there ever any demands that we'll sign this lease, but you can't sell the building or anything of that nature?
Yeah, as you can imagine, tenants will ask for anything they can. And I think it's smart. Starbucks in their lease has provisions sometimes that if the building is sold more than twice during the primary term, which is typically 10 years, they're not liable for the increase in taxes as a result of the sale. And so, yes, oftentimes these properties may be assessed for $800,000-$900,000, and then when they go sell for $2 million, and the assessor takes it up to $2 million,
right,
and their taxes double, yeah, the tenant's not happy about it. But they're sophisticated, and with the new deals they're signing, I think they know exactly what they're getting themselves into.
Right.
So there are some provisions in certain leases like that.
Right.
And typically, again, it's a negotiation on both parts with these developers. Because they know they're going to sell it, they'll make sure to say, hey, it can't be sold more than 2 times, right?
Yep.
Because they know they're going to sell it immediately when they finish development.
Yep. We're going to get into post-COVID lease, but I had one other kind of question because you were talking about access earlier. And I think about sometimes when you're pulling off a highway and you're pulling off the off-ramp and there's no possible way from the time you get off that off-ramp, but there might be like a McDonald's right there. So you're going to have to make a loop somewhere. How much does access matter? Like I think of that Toys R Us out there on 30, best location. I mean, it's boom, and it's impossible to get to.
Yeah, you just can't get to it.
So like maybe the question is more, maybe it's consumer driven. I know it's important to landlords, but let's talk about access for a little bit. How much does it matter? And will tenants or customers literally not go to a Starbucks if they have to make an extra loop around the block?
I think in a perfect world, if Starbucks could have perfect access or any tenant could, they would.
Right.
But there's just some instances where they've got to be in a market and they can't get a better site. So they'll go to an inferior site. And yes, people will still go there. But if Dunkin' Donuts outpositions them and it's easier to get on and off and not make that U-turn and get back on the road, then I think they do lose business to Dunkin' Donuts in that instance. But that's the stuff I nerd out on. I love it. I love looking at an aerial photo and saying, "Oh, look at that off ramp. Look at this access. Oh, there's a light. Oh, curb cut." So I think it's huge. And again, you can relocate a tenant. Starbucks may move from mid block to a hard corner if it ever becomes available.
Right.
Quick Trip does it. Their old model, they would take some mid block locations, and now they're all highway, interstate, hard corners.
Yep.
And so they'll relocate an extremely profitable store just to take a hard corner.
Yep.
7-Eleven, same thing. They used to have those little smaller postage stamp stores. They're doing bigger stores. They'll go to a hard corner. They'll pay more rent. So it's constantly changing.
What about the all for one for all? You typically see this new development. It's always like a Raising Cane's, a Burger King, a Chipotle. Are they all in cahoots, or is everybody looking to see where Starbucks goes and then everybody lines up behind them? How does this work?
Yeah, I think these tenants feed off each other.
Right.
So in the same instance of CVS and Walgreens, you'll always find them across the street from each other or just down the street. And that's because they have the same customer, same client base. So oftentimes it's not, hey, we want to be away from them. We want to be with them. And
Right.
if you have a big shopping destination with all these food options, I think that's why they like it. And really, I think they're following the developer. They're following the anchor tenant. And, these brokers, I think, are in cahoots and say, hey, we're getting ready to do a deal over here. So I really think it's just the sharing of information.
Yeah.
And I think they like it.
All right. We've been living through a pandemic. Some of I would imagine, well, actually not. Maybe most of the tenants in this kind of stuff really never did shut down. They were kind of vital. But you hear a lot about retail leases changing and there's new requests. What things are people requesting now that they didn't before? And is this sticky going forward? Is it more short term and you've already seen it kind of wearing off?
So the answer to the first part of the question is yes, I've seen some tenants try to throw in these new provisions that, hey, if there's a shutdown or, government forces us to close our doors, we get some rent abatement for 90 days, 120 days. Obviously they'll probably ask for an indefinite amount of time, but developers have gotten smart and said, look, we'll play ball with you, but we got to limit it to 30, 60 days. So there's things like that where, yes, I've seen it make it into some leases. I don't think it's affected pricing because I think the consumer knows that, hey, COVID happened. It could potentially happen again. I think there's some creative ways where you can say, look, if we're going to, abate rent for 60, 90 days, we're just going to add it on to the end of the term. So you're not really losing anything.
Right.
So I haven't seen it really affect pricing.
Yeah.
And I think it was something that tenants are conscious of and are going to ask for. But again, do I think they're not going to sign a lease because they can't have call it a COVID provision or some sort of protection? No, I think at the end of the day, if they want to be on that location, you're probably still going to be able to make your deal with the tenant.
And it hadn't affected cap rates on anything being sold with these new leases?
I don't think so. Not in today's market. And then I think the second part of your question was demand for these tenants, and did any of them shut down? With full service restaurants, a lot of them shut down.
Yeah.
Some of them weren't set up for takeout and delivery. But with most of the fast food, there was a 30-day shutdown. But then they ramped up drive-through, and for many of them, their sales went through the roof. So, the result is now everybody thinks that, hey, I need a fast food because I need to have a drive-through.
Right.
I don't want to take the risk on a full-service restaurant.
Right. How does drive-through and delivery, is that changing the way these things are thought about? I mean, I remember Chick-fil-A down here on Montgomery Plaza. Even when everything was open, they were still just doing drive-through.
I think it's huge for these tenants. It's all about convenience. Everybody wants convenience, right? And I think now people, if they're scared to get out of their car and go sit in a dining room, they want to just roll through that pickup window.
Right.
So I think it's great to have. My father-in-law is in the restaurant business, and early on he was always kind of saying, hey, we need to do a pickup window.
Right.
And at the time, the concept that he was with, wasn't doing them.
Right.
And so he said, well, I'm just going to do it, and I'm going to use it as a pickup window. And it boosted his sales, and it was great.
Yep.
And I think it's smart because then, it just makes it more accessible for the next tenant if something should ever happen. So I think it's all about convenience now. And it's increase sales. I mean, for a lot of these tenants, full service restaurants, those cap rates aren't as aggressive as they were, I would say, pre-COVID,
Right.
because people are still nervous about them. Health clubs,
Yep.
not as good. Movie theaters, not as good. So there's this idea out there of what we call essential retailers, right? Fast food with a drive-through, Dollar General, because they never close and they stayed open. And so that's another reason I think these cap rates have compressed so much, is because now the demand has shifted from all these other things. I knew people that would never ever buy a dollar store, and now that's all they want.
Right.
So
that
really just
Dollar
supply and
Tree.
demand. Yeah.
Meyer Marcus has been right for a long time.
Yeah, now's a good time to own dollar stores for sure.
Let's take a quick break to highlight this episode's sponsor, Juniper Square. If you aren't familiar with Juniper Square, it's an easy-to-use, all-in-one investment management software designed specifically for real estate owners. We have been using it at Fort Capital for several years now, and it has completely revamped the experience we're able to provide our investors through reporting, management, and efficiency. Here's a bit more on how Fort Capital utilizes the platform. Depending on how fast you read, you can look at our deal, approve our deal, sign our deal, and send money for a deal in under 10 minutes, assuming you've already understood what the deal is. Like, the frictional cost of how that all moves through our system now is a matter of minutes, and it does not require any human interaction between that unless the investor wants it. We have investors that are in 15 different deals. They can go into their portal online, go to their profile, and everything they could want, from every document they've signed to every report we've sent to every distribution we've sent, every point of contact with them throughout the life of the investment is documented in one place. You can check out episode 37 to listen to my full conversation with Brandon, or visit cjunipersquare.com for more information. That's SEE junipersquare.com. And now back to the show. When you see like a McDonald's or something and they all are updating their storefronts, that's on the operator to do, right? It's not on the landlord like 99% of the time. It's usually the operator doing that.
99% of the time. But that doesn't mean they're not going to ask you for some type of contribution or rent reduction. So they may come to you and say, hey, our sales have been on the decline. We're willing to come in and remodel. We're going to spend $700,000, but we want a new lease and we want to drop our rent 20%.
Why would anybody ever do that for a newer building?
Well, because the tenant's going to come spend $700,000 and sign a 20-year lease. So in that instance, maybe the trade-off is worth it. There's still some landlords out there that probably say, no, that's all right, you can leave.
Yeah.
And then, McDonald's or whoever it is will still do the remodel and still pay the higher rent.
Is there ever, like, if Starbucks is going somewhere, they're going to make money. Like, there's never at this point like a risk. And if they're shutting down a store, it's only because they have a better store down the road. Typically,
or over time, things change, access changes. They move the on-ramp, off-ramp. Things like that can impact them. But most of the time, I mean, these are really, really smart companies that pay a lot of money to figure out where they want to be. They look at the demos. I mean, this isn't just throw a dart at the map. They basically have their development list every year, and they know exactly where they want to be. They've mapped it out, and then that's when the developer will go out and buy in these little territories.
All right, there's some deals that sell that always, like, I don't get it. And maybe you don't either, but that's just how the world is, where the rent is so high that when it sells, it's selling at like 2 times replacement cost. It's so damn high, it's like a joke.
Yeah, I would agree with you.
What are you telling people in a transaction like that?
So again, every buyer's different. Not everybody cares what I say or cares what I think about being able to replace something or the location. Some of these people are just chasing yield. So in that instance, when you have something with an above market rent, it's more expensive than anything else out there. Typically, you've got to adjust your cap rate, right? The return. It's going to be a little bit higher because now I'm trying to attract people to this asset because I know it's not at market. And so there's people out there that will still play the credit game, right? If you're buying, a McDonald's, Chick-fil-A, Starbucks, whatever it is, these are investment grade tenants. It doesn't matter what their rent is. They're going to continue to pay it, and they're going to pay it for the next 10, 11 years. So some people will, I guess what I say is forego the fundamentals and just buy the return.
Okay.
And there's a game for that.
Okay. Is there any up and coming tenants that most people don't know about that you have your eye on?
No, not necessarily that I'm watching, but I do think there's an opportunity when there is an up and coming tenant or a new tenant to the market to kind of take advantage in terms of better yield, right? The Chick-fil-A's, the McDonald's are always going to be a 3.5% yield.
Yeah.
But if all of a sudden you have some new concept that people haven't heard about, maybe it's a 5.5, 6 cap.
Yep.
But if it's a 10 or 15-year lease, if it's a great corner, all of a sudden, hey, you've got some more yield there. So, and as those tenants become, more, Raising Cane's is a good example. When they first started their rollout, they were selling at 7.5 caps.
Yeah.
Because people hadn't heard about them. People were like, oh, well, Chick-fil-A's the game in town.
Yeah.
And then little by little, they just kept growing. Now they're everywhere. And now their cap rates are, 4.5,
Yeah.
5.
And then obviously it accrues to the real estate owner, but Popeye's coming out with that amazing chicken sandwich ultimately made all the landlords of Popeye's chickens really rich too.
Oh, yeah.
That's kind of a cool way to think about it.
Well, I mean, their rent doesn't change.
No,
but
it doesn't change at the moment.
Yeah, but it provides security and it they can sleep better at night.
Yeah,
put
maybe
it that way.
Gave a little cap rate compression if they went to sell it. All right, if I lived in California and I was looking at a Starbucks in Texas and I was afraid to fly and I didn't like 20-hour drives, basically what I'm asking is if I had to do my due diligence without ever seeing this property, what do I need to be looking at?
There's a lot of people that don't even come and look at it.
That's what in your world, it's probably a lot more of that than in most asset classes.
Oh, for sure. Because the tenant's responsible for everything. Mm-hmm. So a lot of these people will just use Google Street View and they'll rely on our marketing package. Occasionally I'll go out and, hire somebody to refly the drone and do a video and kind of show them if they can't get on a plane. But a lot of times they don't come out and see it.
Yeah.
And on the other hand, there's a lot of people that, they will get on that plane. They'll come in for the day and then they'll fly home. They'll just kind of look at it and feel out the area.
Yep.
But again, the people that want the Starbucks in DFW, there's not a whole lot of them. Yeah. So, they'll typically just move on it.
Yeah. And they'll look at the lease.
Yeah.
They'll look at the pictures. They might hire a local inspector just to go out and do the building and send them the report.
Yeah. And for them, it's passive. Right. Oftentimes we're selling to people who have sold out of apartments, who've sold out of office buildings, sold land, whatever it may be, and now they're coming to Texas because it's business friendly, and they want a 5% yield instead of because they're selling at a 3 or 4 cap in California, coming here and buying at a 5.
Yeah,
and they don't have to do anything. It's music to their ears.
Do ghost kitchens make you nervous at all about what you're selling? If Chick-fil-A is doing half their sales out of delivery and they just decide to start going into industrial warehouses, is that on your radar?
I've had people ask me that question, and are they ramping up? Do I think it's a viable business model? Absolutely.
Yeah.
I think it's going to change the game for some people.
Yep.
Hooters is doing a new concept called Hoots, where it's their wings. I mean, people, they go to Hooters for the wings and the beer and everything else, but really it's the wings. So they've got a new concept where they're going to, 1,200-1,500 square feet and they're doing their wings, and it's rolling out here in DFW. I think they're doing 40 or 50 locations.
Damn.
So you'll start to see those. So I think that the model is changing. I think ghost kitchens will have an effect on some of those things.
Yep.
But again, like the Chick-fil-A's of the world, the Starbucks, I don't see it impacting that.
Yeah.
I think it's more on the kind of the full service restaurants.
You have some amazing clients, some of which I know, and you've done over almost $1 billion in transactions. Every now and again, you get to buy your own deal or partner. What's your favorite deal you've ever done?
So, I've got a very good client that has honestly just become a best friend.
I know.
And a mentor. And early on, he just, he said, you need to buy real estate. And I believe in it. It's what I do. I love it. I think it's a great investment if you know what you're doing. And so I've been fortunate enough to partner with him on some stuff. My favorite deal.
Is it the 7-Eleven?
Yeah, that's one of them. That's one of them. Probably the
Walk me through whichever one you decide to pick.
it was easy. They were paying, $11 a foot in rent, and they'll pay 60, $70 a foot someday. Now, that was one of those situations where I've talked about you're going to have to wait 11 years for the upside, but you can drive by it every day. You know they're busy. You know they're never going to leave. They'll never get another permit to do gas on that street. And so it's what I talked about, that wealth preservation. And so for me, being younger, it's something I have to look forward to. So those are the types of deals that I like.
And in that 11 years, you're basically covering debt service. There's not maybe letting some cash build up in the account, but there's not really a whole lot going on for 11 years. And then
it was a savings account is what that deal was.
Yep. But in 11 years, it's not necessarily life changing, but
yeah,
it's going to be a big change.
You own a good asset, and that's one of those situations where there's no downside.
What does a bank tell you when you take them a flat deal for 11 years? They're like, look, as long as our debt service is covered and it's 7-11, it's good.
Yeah. And I think for them, they all have their model they have to hit. So as long as you can meet debt service and they know what it is, and if you've got a relationship, it's not going to excite a lot of lenders. But again, depending on the situation, I think there's a lender out there for every deal.
All right. I kind of asked a question, and then I kind of answered the question for you. Was there another deal that you were going to talk about?
We've got again, very, very small ownership percentage for me. I just, I'm a limited, but we bought a property down in Houston that was 4 acres, and on 1.5 acres was a CVS ground lease, paying $160,000 in rent in a market that they should probably be paying $400,000. So again, it's a long time before you get to that upside, but one, they're never going to leave. And we could probably sell the CVS and pay off the rest of the property and own it free and clear. So that's a pretty cool deal.
What would you do with the other 2.5 acres?
It's leased. There's a shopping center. Yeah.
Got it. And you're not just in Texas. Like, you'll sell anything anywhere, or are you just in certain states?
So Texas is our backyard.
Right.
A majority of our business is in Texas. I'd probably say 80% of it. But we've sold in 30 something states.
Yeah.
And with these net lease assets, you can sell across the country. And I've sold a lot of stuff that I've never even seen.
Yep.
But it's the game. It's a 15-year lease. It's a 10-year lease. You know the credit. You can kind of look at the map and see the usual suspects. So I can't remember the state count, but we're 30 plus states, and
yeah.
But a majority of what we do is in Texas.
Yeah. You've been at Marcus for I keep saying 15 years, but I think it's 15 years, maybe in 2022. You got there in 2007. Is there a reason why you've stayed there so long? Is there something that they're bringing? You've always spoken so highly of them, but why is that?
So really at this moment in time, it's more about the family, right? I've been there so long. These aren't my coworkers; they're my family members. So we've gotten to know a lot of these people. We've gotten very close with them. Some of our senior leadership people we're very close with. Our wives are friends, and they really do a tremendous job supporting their agents.
Yeah. And
so with the leadership change we had, probably 5 years ago, it was really focused more on the agent, right? And again, things change and leadership changes and cultures change, but it's a tremendous culture. And like I said, it's just really a family. And they support me. I can come in every day and know that they've got my back. I joke with my manager, who I meet with every week, that, yes, he's my manager. He gives me business advice, but he's also my therapist.
Yeah.
So it's just a fun business. And, sure, I get recruited. I get offers all the time. But, at this point, this would be walking away from my family and something great. And as long as they support me and, they continue to focus on the agent and the client and development and provide support, I'm happy.
I love it. And what is there? How many agents are at Marcus across the country?
Oh, I'd say probably 2,000 agents across 80 offices, or in Canada now.
And do y'all have a way to share information and insight and intel that keeps you kind of crisp?
We do. So the company does a lot of webcasts.
Yeah.
And there's a lot of collaboration, but we have our own kind of internal system.
Right.
For information sharing. And it's not a gimmick. It's not a sales pitch. It's real.
Yeah.
when you hire an agent, no matter where they are, they may be in Orlando, they may be in Oklahoma City. When you list with them, it goes into our internal system, and all 2,000 agents have the ability to see it, work the deal,
Yep.
plug their clients in. We do a lot of crossover buyers. So we may have somebody in New Jersey that just sold apartments. He picks up the phone, he calls me, says, "Hey, I saw your listing down in Texas. Walk me through it." So again, it sounds like a pitch, but you're not just hiring me or just hiring one guy. You're literally hiring an entire team.
Yeah.
And so I think that information sharing and that collaboration, again, is what makes us the best in the business when it comes to investment sales. Other people claim to have the same thing. Sure they do, and to a certain extent, but
And all y'all do is investment sales.
That's
No
all we do.
leasing, no anything else.
no leasing, no management. Like I said, I look at myself more as an advisor. Do I have a lot of information? Can I advise somebody on a lease renewal? Can I arm them with information? Absolutely.
Right.
But yes, our core is purely investment sales.
You've been in the business for 15 years now. Is there anything that still like surprises you or shocks you, or is there anything that you're still really excited about?
I get excited every day, and I think that just comes down to competing.
Yeah.
I love to compete. I like winning business. I like when a client tells me, "Hey, that was a great job. That was the best execution. I've been doing this a long time. Your team is great." So for me, that's what excites me every day is kind of gaining more business, winning more clients. If I'm in competition on a deal, with the example of the Albertsons being able to sell it for $1 million more than my competition, it just makes the repeat business easy, right?
Yep.
I don't have to compete anymore once I deliver. So that's what gets me excited. The thing that continues to surprise me is today's market. Every time I look at this, I think, well, there's no way cap rates are going to get lower. Oh, that's a record. Oh, that's a one-time thing, and then the market just continues to compress.
Yep.
So we just sold a Taco Bell franchisee. We put it on market at a 4 cap.
Okay.
We ended up with 8 offers the first day, and ended up closing in 14 days at a 3.76 cap on a franchisee.
What? And a franchisee means it's not owned corporately; it's owned by a local guy.
Yeah, not Yum Brands, just a franchise operator.
What?
Good franchisee, but still, I mean, that's crazy.
Okay, well, great opportunity for me to ask a question. The difference between a franchisee and the franchisor ownership. Are you underwriting the franchisee when you buy that? Oh, this guy owns 20 Taco Bells. He's been doing it 20 years. Clearly, he's great. How do folks look at that?
Absolutely. So there's typically always a difference between your corporate credit versus your franchisee.
Right.
I think it's compressed in this market to where it almost doesn't matter.
Yeah.
Right. Historically, I'd say there was probably a 50 to 100 basis point difference. But in today's market, I mean, a corporate Taco Bell would sell at a 4 cap, and we just beat that with a franchisee.
Yep.
So again, that came down to location, price point, rent. It was under $1.5 million, which is also difficult to buy in today's market because rents are so high, pricing's high. It's hard to find a good triple net asset under $2 million. So this being under $1.5 million, I knew we'd be able to, command a premium. And that was a deal that we were competing on. Even when I said, we'll get a 4 cap, they were like, "Are you just telling us that because you want the listing?" I said, "Oh no, we'll execute. I promise." Did I think we'd get a 3.76? No, but I knew I'd get the 4. So again, I think that's just knowing the market, being in touch with, what the supply is, and knowing what people will pay for.
So under 2 million total purchase price is a hot ticket item.
Oh yeah.
Just because there's lots more transactions happening at lower price points.
Yeah. And it's just as simple as the simple way to think about it is it's more affordable. There's more buyers. There's more people out there with money to buy something under 2 million than in the $2 to $5 million range.
Yep.
So, and those are typically your 1031 exchange people, private family offices, people that have got some funds left over from maybe a larger transaction. So it's difficult to buy under $2 million.
Okay. So if you're under contract, once you've gotten the listing, you've got your buyer, you're under contract. I mean, what the hell can really go wrong during a contract?
So that's not a funny story. I'm not laughing, but A lot can go wrong because we one time were selling a Capital One.
Okay.
And it was a huge, huge rent.
Okay.
And it was a big price point. We'd been through due diligence, money was hard, everything. And then they announced that they were going dark.
They announced like they were going to shutter the store.
Yeah. Now they were going to continue to pay rent for the next 8 years. But, selling a dark asset, who wants to buy that, right? It's going to be a developer or somebody that's going to, re-tenant it in the 8 years. But most of these people don't want to buy a dark building knowing their tenant doesn't want to be there. And so that was a situation where the buyer was already pregnant with the deal, was moving towards closing, and there wasn't going to be an adjustment in price. Selling a dark asset that still has a lease in place for selling, something that's open and operating is a big difference in pricing.
So the eventual buyer of that Capital One probably bought it and said, look, I'm sure they worked out something with Capital One that said, look, we're going to try and release it. Or does Capital One sometimes say, no, we want to keep paying, we might come back? Or usually if they go dark, it's like, hey, help us try and lease this
Yeah,
thing.
I think it's a team effort. Do I think they want to pay for the next 8 years? No.
Yeah.
Do I think they want out of the lease? Yes. So again, you don't have to take the buyout. I'm sure that they offered some type of buyout. You can work in tandem with them. You can hire a leasing broker, but the reality is they're going to hire their own team to go out and sublease it and try to, bring you a replacement tenant. So it's not always a bad thing.
Yep.
You don't really have to do anything. You can still collect the rent for the next 8 years.
Yep.
And they've closed, a significant amount of branches here in Texas, and we've sold a bunch of these that have been going dark. But again, the yield is a little bit higher because it's a little more risky. Your tenant's not going to be there in 4, 5, 6, 7 years. But a developer can come in, cash flow, put debt on it, meet the debt service requirements, and they basically have 7 years of income to figure it out.
Right.
So again, there's different buyers for all types of deals, and
Yep.
and I like those if the real estate's good.
How much volume are you expecting for the rest of 2021, given the 1030 or given the possible tax change at the end of the year? Are you seeing an abnormal amount of volume, same as normal? What's the last few
the
quarters
market is crazy. I've never seen it like this, and I think everybody is scrambling to kind of make their moves before any sort of changes occur with the 1031s or taxes, anything like that. So there's just been this flurry of deal flow.
Yeah.
And right now there's a supply issue. And so, for us as a team, we've closed 80 million this year, and we still have 19 deals that are under contract, and that's probably another 90 million. And then we still have, 60, 90 days to close out this year, and that's the stuff that'll all close. So, we might get to 200 million as a team this year, which would be our best year ever.
That's unbelievable.
So, it's
And our buyer is a lot of that driven by the tax rate change. People are scared about inflation.
all of the above.
Yeah.
And I think that there's so much cash out there. I think during the shutdown, people were hunkered up, not doing anything. They were remodeling their house and, fixing their garden and things like that. So there's just a lot more disposable income out there with all the stimulus money. Well, these aren't the people buying real estate, but I think that they've been sitting on the sidelines, and now they're looking for something that can weather the next storm.
Yep.
So stock market took a big hit. I tell people buying these triple net investments is a lot like investing in bonds, but the difference is your collateral is a piece of real estate.
Right.
So as long as you buy good real estate, you're always going to have something.
Yep. All right. A couple more questions. Maybe one or two more. I looked at a deal that I've looked at all. If you're not on Vince's newsletter, you need to be on his newsletter. He sends listings out every week and tons of awesome insight into retail. But I always look at the deals, even though I'm not a retail guy. We've talked all about the credit tenants, but I've seen you sell like I'll call it like a party center. It's got like a stage. It's got food and beverage. I can picture families coming there and spending tons of money, but it's like this big piece of land. It's kind of few small buildings on it. I'm trying to paint the picture here. How do you sell something like that? Like, who's going to buy that? And is that typically a percentage of rent deal to make it work?
So, most of these, again, we'll partner with developers on the front end or with owners that are signing these leases. Most of the people that are buying these want to know what their return is for the next 25 years.
Yeah.
They don't want to buy something on percentage rent or this future dream.
Yeah.
Because what if the concept fails? What if, they never hit that percentage rent,
Right.
right? So it's hard to put a value on it. It's hard to cap it. It's hard to get somebody to accept it. So oftentimes we're just advising these developers or these owners just bake it into the lease. Whatever
Right.
they think they're going to do, come up with a number that everybody can live with, and that's what it's going to be for the next 5 years. And you're going to hit these types of escalations. So the buyers for these, again, your return is going to be a lot better on something like that versus buying the Chick-fil-A, the McDonald's, the AutoZone, just because of the credit.
Right.
But again, if, like you said, a lot of these can make sense because they're sitting on 2 or 3 acres. Again, depending on what your basis is, it can just make a lot more sense. And in that instance, your cap rate, I think I know the deal you're talking about, is going to be 6+
Yeah.
versus a 3.5 or a 4.
Right.
So it's just a lot more attractive from a borrowing standpoint, yield standpoint. You can still be in a major metroplex.
Okay. All right. One more question. If I was getting into the industry today, you'd mentioned some books, maybe some things you did early on. Like, what are you telling folks right now if they're getting in the industry today, how they need to be thinking about it?
A lot of reading. For me, I studied the market. I had alerts set up. Every listing that came to market in Texas in my backyard, I was logging in Excel, and I would just study these cap rates, and I would get a feel for, hey, here's 4 Whataburgers on market. All of their rents are between $75,000 and $90,000. And I would just study these and look at the numbers and the data so that when the next one came to market, I knew how it would be priced. I knew what to expect in terms of price point rent. So for a lot of the new people getting into it, if you want to get into brokerage, I just collect this data. I analyze it. I still do. People are surprised. Like, I'll go on a meeting with one of my partners, and this guy will say, oh, yeah, we bought this deal in Austin on 35. It had this tenant in it. You probably never heard of him. And I'll say, oh, yeah, that was that building with and you bought it for $3 million. And, my partner looks at me like, how do you know this? But I'm always looking at everything that comes to market.
Right.
I'm curious. So I think I do a lot of reading in the mornings. I look at all these news outlets and articles, all real estate related, really.
Yeah.
And so I tell young guys early in the morning, get up, have your coffee, study the market, look at what's happening. Yeah. I look at close comps, right? And so over time, when you just look at this over and over and over, where something should be. Right. I'm not always right, but I could price a deal.
Yeah. Every time I send you one, you're like, pretty, it takes you about a minute to give me a price.
So, no, just a lot of research.
Yep. All right, man. Thank you very much for sitting down with me this morning.
Yeah, that was a lot of fun.
That was awesome.
We'll do it again.
We'll do it again. All right. Hey everyone, it's Chris here again. Thank you so much for joining me on this journey. If you enjoyed the show, please subscribe to us on Apple Podcasts, leave a 5-star rating, or write a quick review. Thanks again, and I'll see you on the next episode.
Chris Powers is the founder and CEO of Fort Capital LP. All opinions from Chris and guests of the Fort Podcast are solely their own and do not reflect the opinions of Fort Capital LP. This podcast is for informational purposes only and should not be relied upon for real estate or investment decisions. The Fort with Chris Powers is produced by Straight Up Podcasts.